In volatile markets, you might log into your investment accounts, scan the numbers and think, everything is down. Diversification didn't work. It's a completely reasonable reaction. You own different funds, sectors, and maybe even asset classes, yet they all seem to be moving in the same direction, down. At that moment, diversification doesn't feel just disappointing, it feels misleading. But that reaction isn't a sign that diversification has failed. It's a sign that diversification is being judged by the wrong standard. Hi, I'm Adam Tiernardi, Portfolio Management Associate at Claret. In this video, we'll look at what diversification actually does, why it can feel ineffective during market stress, and why that feeling is often a misunderstanding of its purpose. Let's start with what diversification is not meant to do. It's not a guarantee against losses. It's not designed to ensure that something in your portfolio is always going to go up. And it's not a tool to eliminate short-term volatility. If diversification could do all that, investing would be easy. A better comparison is a seatbelt. Wearing a seatbelt doesn't prevent accidents, and it doesn't make the ride perfectly smooth. It can reduce the severity of outcomes when something unexpected happens. Your diversified portfolio behaves the same way. It can't stop market shocks, but it can reduce the damage when they occur. At its core, diversification reduces concentration risk, the risk that a single investment, sector, region, or economic outcome dominates your results. Instead of relying on a single forecast being correct, diversification spreads your exposure across different assets that respond differently to growth, inflation, interest rates, and economic shocks. Think of it like weatherproofing a house. You don't prepare only for rain or only for snow. You prepare for a range of conditions you can't precisely predict. Diversification doesn't remove uncertainty. It accepts uncertainty and distributes it. The goal isn't certainty, it's resilience. So why does diversification sometimes feel like it stops working right when you need it the most? Because during periods of market stress, markets don't behave neatly. As uncertainty rises, correlations rise. Assets that usually move differently may temporarily move in the same direction. In moments of fear, investors tend to sell broadly rather than selectively. When that happens, diversification can feel broken, even though it's functioning exactly as expected. Most of the time, an insurance policy feels unnecessary. Its value only becomes apparent when something goes wrong. Another common misunderstanding about diversification is confusing volatility with risk. Volatility is price movement, both up and down. Risk is the chance of not meeting your long-term financial goals. A diversified portfolio can still be volatile. What diversification reduces is the risk that a single mistake, theme, or scenario permanently damages your plan. Short-term discomfort and long-term damage are not the same thing, even though they often feel that way in the moment. So, where does diversification add the most value? Diversification adds the most value over full market cycles, not over months or even single years. Its benefits become clear when the market leadership changes, when valuations normalize, and the future stops looking like the recent past. Markets rarely reward the same assets forever. Diversification helps prevent building a portfolio perfectly suited for yesterday's environment, but fragile in tomorrow's. It allows for disciplined rebalancing. This means trimming assets that have grown beyond their intended role and reallocating to areas that have lagged. This isn't market timing, it's risk management. Systemic rebalancing can improve long-term risk-adjusted outcomes and reduce emotionally driven decisions. At its core, diversification answers one simple question: can this portfolio survive outcomes we can't predict? If the answer is yes, even during difficult periods, then diversification is doing its job. Diversification rarely feels exciting. It often looks unnecessary right before it becomes essential. But over time, it does something far more important than chasing the best performer. It keeps you invested long enough for compounding to work. And that's where long-term success really comes from. For more investment tips, visit our website, claret.ca, and don't forget to subscribe.